Hello everybody and welcome to another video on the finance channel. Today we will be looking at an incredibly interesting topic that is actually very important and not a lot of people actually pay attention to it at all. Like, really. Today we are going to talk about debt and how it's affecting the average consumer and their ability to spend and participate in the economy itself. Because as you can imagine, if they can't be a part of it all, then inflation will come down, sure, because people can't buy, but we might end up with deflation or an economy that completely falls apart. So it is something that we need to keep in mind. So let's look into all of this. Now, as you can see on the screen right now, I have a couple of pages open with important data related to how consumers are doing and their spending habits and the debt obligations they have and whatnot, in order to get an idea if they're able to cope with the current increases in the cost of debt due to interest rates rising and also the pressure from inflation. Now, to start off, we will look at a chart which is known as the household debt service payments as a percentage of disposable personal income. So how much are people spending on maintaining their debt? Not paying off their debt, just maintaining it. Well, as you can see from the chart right here, it's currently at an almost all-time low. Ever since the corona situation hit, it has been really low. A level that isn't very worrying, to be honest. Because if you look at 2008, you can see that around the 13% mark, things became very hard for the average consumer. More than 10% of their money went towards just servicing the debt, paying the interest on debt. But at the moment, while it has been rising off the lows in 2021, it is still only at 9.5%. Which is the lowest we have seen in years. Like, it was higher in 2018, 19, 17, 15, 14, 2008, and even the 80s and 90s, the cost of debt and servicing it was a lot higher than it is now. Now, sure, this might change because, again, interest rates are rising. However, people were also able to secure a lot of very cheap loans during the COVID crash and the whole COVID situation. Surprisingly enough, a lot of people actually remortgaged, and so their new mortgages had lower interest rates and they locked those in for long periods, usually at least 10 years, and now they're paying absolutely nothing on their mortgage. We're talking about an interest rate of maximum 4%, while the current inflation levels are around double that. So, as you can imagine, currently consumers aren't struggling with debt, and they most likely won't struggle with debt in the future either because they were able to get such cheap loans during the whole corona situation. But this isn't the only thing we are going to look at. Another important ratio that we need to keep in mind is household debt to GDP. And GDP is basically the yearly income of the American economy as a whole, which is currently sitting at, I think, $23 trillion per year, if I'm correct. Yes, it's currently standing at $23 trillion per year, and GDP stands for Global Domestic Product. So basically, the amount of value that the entire American economy generates. Now, as you can see in the chart right here, currently we are sitting at 80%. So people are holding around, right, let's do the math real quick, $19 trillion of debt. Now, while this might sound very scary, it actually isn't that big of a problem. Sadly enough, we don't have a huge data set here, and sadly enough, the most recent data we got was from Q4 2021, and as we all know, this year inflation really took a hold and interest rates went up a lot, so the situation might be different now, but 80% still isn't that big of a problem. Even if it went up to 85, it's not the end of the world yet. As we can see from the 2008 financial crisis, anything around 100 or above 100 actually, that is going to be a problem. But we are nowhere near that number, so for now, it should be fine, but personally, I really hope that the Federal Reserve, because this is the website from the actual Central Bank of America, so this is from the horse's mouth, to put it that way, I really hope that they will upload or share like more recent data with us, because I would love to know how the current 2022 situation is. But sadly enough, we don't have those numbers. Now, the next thing we will look at is actually credit card debt. Because, well, most Europeans don't actually use credit cards like at all. Like, nobody I know has a credit card, and if it's a credit card, it's a debit credit card, so one that you put money on. In America, credit cards are like a very big part of their entire economic system and just life in general, because they also decide your credit score, which tells people who want to borrow you money if you're able to pay it back and how good of a person you really are. Now, at the moment, credit card debt is actually quite high in America. As you can see, it's sitting around $927 billion in total. And soon we will actually see a new all-time high when it comes to credit card debt. And as we can see from a situation like 2008, too much credit card debt is not a good thing. Certainly isn't. And in 2019, it was also climbing fast, which isn't a good thing. And as you can see right now, we are once again almost at an all-time high. However, this time the effect won't be that big. Because what you gotta remember is that in the meantime, ever since 2008, the economy has actually grown from around $15 trillion to $23 trillion. And so $900 billion isn't that big of a number anymore with the economy growing that much. So while this might look extremely scary, and it is something to keep an eye on, because if this keeps growing aggressively, then we are in for trouble, it isn't the end of the world yet. But it isn't amazing either. And it's especially a big issue because interest rates on credit cards are absolutely mind-boggling. Personally, when I saw these numbers, I knew credit card interest rates were high. But when I saw that you paid an average of 20 to 18% interest per year on the balance of your card, well, the debt on your card, actually, I was quite shocked. I really don't understand why so many Americans rely on credit cards. This is some of the dumbest stuff I've ever seen. Why in God's name would you take out a loan that has an 18% interest rate? That's astronomically high. And no matter where you go, and no matter what kind of card you get, all of them are incredibly high. Anything above 10% is insane, to be honest. So this could spiral into a bit of an issue if credit card debt becomes too high, and people can't deal with these interest rates, and the whole situation kind of snowballs. Because people don't pay off the debt, and they get the interest, and it becomes even more debt, and that grows by another 18% that year, and then whoa, and it becomes bigger and bigger and bigger. That is the danger of credit cards for a person, but also the economy as a whole. But luckily enough, as we can see from the data right here, delinquencies are quite low. Currently, it's sitting at 1.8%, which is one of the lowest levels we have seen in history, actually. And as you can see from the 2008 crisis, if we get anywhere above 5 to 6%, then we really get into a dangerous situation. However, at the moment, it's just 1.8%, and even if this 1.8% doubles to 3.6, it is not necessarily the end of the world. Especially if interest rates come down at that point again, and the central bank kind of calms down, and inflation comes down, and everything kind of calms down in general. And at the moment, it does look like inflation is cooling down fast, which is good. Now, for our last little statistic, we will be looking at the personal savings rate. The amount of money people have on the side for emergencies or whatever. And this is the percentage based on yearly income. Currently, it's sitting at 3.4%, and it kind of spiked during Corona because, like, the government gave everybody insane amounts of money in America, but currently it's sitting at 3.1%, which is quite low. The last time we saw those levels was 2005. So while this is worrying, it isn't the end of the world yet. And this could easily reverse if inflation actually comes down and interest rates stop growing exponentially or even come down next year. That way, borrowing will become a lot easier, and people can service the debts easier and can pay off their loans easier, including mortgages or car payments. And people have more money left over, allowing them to save a bit of money instead of losing it all at the gas station and the supermarket due to higher prices. So it's important to keep an eye on the inflation and interest rate data to see if this could potentially reverse. Personally, I find this together with the household debt, which is growing fast, at least in 2021 it was. I find those two things the most worrying. Now, thank you all so much for watching this video. I hope you enjoyed. I'm going to try to upload 2 videos a week on this channel. If you have any questions or any suggestions for anything, leave them down below in the comments. Be sure to like, subscribe, click the bell button, do all the good stuff, help your boy out. And I will see you all in the next one. Bye!